This morning, silver is sitting at 66 or 67 an ounce. 3 days ago, it was at 63.52, the lowest it's been since December. And yesterday, it ripped 7% higher in a single session. Now look, I know what you're thinking. That's just volatility. Metals are all over the place right now. It doesn't mean anything. But here's the thing I want you to stay for. A 7% single session rally in silver is not the story. The story is when that rally happened, and what was happening around it when it did. Because silver didn't rally on good news. It didn't rally because inflation came in cool. The May CPI just printed at 4.2% annualized, the worst reading in over 3 years. It didn't rally because the Middle East calmed down. The US launched fresh military strikes on Iran this week. Iran retaliated against Gulf states Wednesday morning. India summoned a US diplomat Thursday after an American attack on an oil tanker. And the European Central Bank raised interest rates to 2.25%, the first major central bank to hike in direct response to war-driven inflation. Silver rallied through all of that. And this morning, right now on Friday, June 12th, there are reports that Trump and Iran could be hours away from a peace deal. Trump himself said this morning it could happen as early as this weekend. I want to walk you through exactly what is happening, not what the media is covering, not the Twitter hot takes, the actual structure of this market, where it is, how it got here, and the specific sequence of events over the next 3 to 4 weeks that will determine whether this is just a dead cat bounce or the beginning of something significantly larger. Because I think the crowd is looking at the wrong data. And by the time they figure that out, the easy part of the move will already be over. If you're new to silver, let me give you the fastest possible context so this video actually makes sense for you. At the start of 2026, silver was already one of the best performing assets on Earth over the previous 12 months. It had surged more than 150% year over year. In January alone, it rallied another 44% to hit highs near $115 per ounce. The structural story, which I'll get into in depth later, was firing on every cylinder. Then January 30th happened. President Trump announced he was nominating Kevin Warsh as the new Federal Reserve Chair to replace Jerome Powell. And in a single trading session, silver crashed 33%, not 3%, 33% in one day. Why? Because Warsh is known as a hawk on inflation, a man who has publicly criticized the Fed's easy money policies for years, who wants to shrink the balance sheet, who views rate hikes as the first line of defense against inflation. Markets immediately priced in a dramatically tighter monetary policy environment. And precious metals, which love low rates, got hit hard. And then, just as the market was trying to recover, the Iran situation escalated in a way that completely hijacked the timeline. The Strait of Hormuz got disrupted. Oil prices spiked. That spike passed through into every consumer price index in the world. May CPI comes in at 4.2%. The ECB hikes rates. Warsh hike expectations start climbing. Dollar strengthens. And silver, which was already fighting through the Warsh overhang, now has a geopolitical inflation problem layered on top of it. From the January high near $115 to Thursday's low of $63.52, silver fell roughly 45% in about 5 months. But here's the thing about a 45% drawdown in an asset with a structural supply deficit, 6 consecutive years of demand outstripping supply, and a gold-silver ratio at its most extreme reading since the pandemic crash. That is not a broken thesis. That is a compressed spring. And compression only lasts as long as the forces doing the compressing keep pushing. I want to introduce you to a concept that experienced market observers use that never shows up in mainstream financial coverage. It's called texture. A market doesn't just have a price. It doesn't just have a chart. It has a texture, a feel to how it's moving. And right now, this market's texture is different from a market that is going to keep falling. Let me show you exactly what I mean. Thursday morning, silver July futures opened at 63.52s. That is the lowest opening since December 2025. That is a new low for this entire correction cycle. And then it did something specific. By 7 a.m. Eastern, it had recovered to $64.06. It held above $64 through the session. And by the close, it was near $63.80. Then yesterday, the day after, it ripped 7% higher on reporting that the U.S. military had completed its latest round of Iran strikes, with markets interpreting completed as a signal that the current escalation cycle may have reached its terminal point. And this morning, Trump says a deal could come as early as this weekend. Let me be specific about what just happened on Thursday technically, because I think it matters. When a market makes a new low for a correction cycle, meaning it goes somewhere it hasn't been the entire time and then doesn't close at that new low, that is called a reversal day. The lower shadow you see on the candlestick shows you where the sellers pushed the price. The close above the open shows you where the buyers stepped in and held. That is the market's way of printing a picture of the balance of power shifting. It's not confirmation that the bottom is in, but it is the first signal that the sellers may be running out of new participants. Think about what it took for silver to make that low on Thursday. A 4.2% annual CPI print, worst in 3 years. Live military strikes, Iranian retaliation. An Indian diplomatic incident, a $1.77 trillion SpaceX IPO pulling capital out of every other asset simultaneously. The ECB hiking rates, a hawkish Fed chair 5 days away from his first press conference. Every single bearish catalyst fired at the same time. And silver opened at its lows, then recovered and held. That is exhaustion. That is what the end of a selling cycle looks like before anyone is willing to say it's over. Okay, I want to give you the single most important data point in this entire video. And I promise you, it has been almost completely absent from the financial coverage this week, buried under the CPI headline and the airstrike news. The gold-silver ratio right now is approximately 65-1. For anyone who doesn't know what that means, you divide the price of gold by the price of silver, and it tells you how many ounces of silver it takes to buy 1 ounce of gold. When that number is high, silver is historically cheap relative to gold. When it's low, silver is historically expensive relative to gold. 65 is not a normal reading. CoinDCX's analysis published this week states directly, and I'm paraphrasing, not quoting, that at a ratio above 60, silver has historically outperformed gold over the following 12 to 24 months in nearly every measured instance. We're not at 60, we're at 65. And we've been above 60 long enough that the historical window for outperformance is already well established. Now, add to that what we know about the structural picture. Silver just recorded its 5th consecutive year of supply deficit. Demand is outstripping supply by tens of millions of ounces annually, and that deficit is not going away, because 72% of silver is mined as a byproduct of copper, lead, and zinc. Silver miners cannot just turn on more supply in response to price signals. The lead time on a new mine is 5 to 7 years minimum. And the industrial demand side? Even with solar manufacturers using slightly less silver per panel due to efficiency improvements, total solar installations have exploded so dramatically that overall silver consumption from the photovoltaic sector is still near all-time highs. EVs use roughly 67 to 79% more silver than conventional vehicles. Data centers, AI infrastructure, medical equipment, every major growth sector of the next decade runs on silver. Bank of America's head of metals research, Michael Widmer, has a silver target this year of up to $309. JP Morgan's research note from April put the year-end target in the $84 to $85 range, and explicitly stated that prices should move meaningfully once Strait of Hormuz flows normalize. None of these analysts built their targets around a war. They built them on supply deficits and industrial demand. The war didn't change those fundamentals. It delayed the timeline and created a discounted entry for anyone willing to look past the headlines. All right, now I want to give you the framework I'm using to think about what happens from here. Because a recovery in silver is not a single event. It is a sequence. And if you understand the sequence, you can position for it instead of reacting to it after the fact. There are 3 phases. Phase 1, the exhaustion floor. This is where we are right now. Recoveries in silver don't begin with good news. They begin with the sellers running out of sellers. The participants who were going to sell have already sold. The leverage longs who were going to get margin called got margin called. The retail investors who were going to panic, they panicked. What's left behind is the structure. The physical buyers who were waiting at $63 and $64 for exactly this moment, the commercial hedgers covering short positions, the long-term institutional allocators who bought during the 2025 bull run and have zero intention of selling at a 40% discount to where they entered. Thursday's reversal day at 63.52 is the signature of phase 1. It's not confirmation that it's over. It's the first signal that the selling is exhausted. Phase 2, the confirmation sequence. This is the next 3 to 4 weeks. Phase 2 is where we find out if the recovery has real institutional backing or if it was just a dead cat bounce that rolls back over and makes a new low. And there are 3 specific signals, 3 things you need to watch in exact sequence that tell you which one it is. Phase 3, the acceleration. This is what happens if phases 1 and 2 confirm. And I want to be precise here because the mechanism is not intuitive. Silver at phase 3 doesn't rally because positive news arrives. It rallies because negative news stops arriving at the rate it has been. The short sellers who have been building positions since May's high near $87 are sitting on enormous paper profits and facing a choice. Cover and lock in gains or hold and risk a reversal. When the first of the negative forces changes direction, those shorts start covering. When they start covering, the price moves against the remaining shorts. When the price moves against them, the rest start covering. That cascade is the acceleration, and by the time it's visible to the crowd, the first 15 to 20% of the move is already gone. All right, here are the three specific signals that determine whether phase 2 confirms. Signal 1, the COT report, today, 3:30 p.m. Eastern. The Commitments of Traders report releases this afternoon. This is the data that shows commercial hedgers, the smart money, and large speculators what their positioning looked like at the $63 to $64 price level. This is the deepest level of this entire correction. What you're looking for, commercial hedgers, accelerating their short covering while large speculators are still reducing net longs. That is the same signature that appeared at the March 23rd panic low before silver recovered from that level all the way to $86 in May. Commercial covering at the lows means the players with the most information about the physical market believe the floor is in. If today's QOT shows commercial shorts being aggressively covered at $63 to $64, that is signal 1 confirmed. Signal 2, Kevin Warsh's first press conference, June 17th, 5 days away. This is the most market-moving event on the calendar for precious metals right now. It's not just a rate decision. Markets are already pricing a 97% probability of a hold at this meeting. The rate decision itself is essentially settled. What matters is the dot plot and the press conference tone. Here's the key. Silver doesn't need Warsh to pivot toward cuts. It doesn't need dovish language. It just needs Warsh to acknowledge that the inflation environment is geopolitically driven, not embedded in wages or demand, and that the Fed is monitoring risks on both sides of its mandate. Language that keeps the December rate hike probability stable or declining. Silver gets monetary breathing room to build a base. The scenario that kills phase 2 is a Warsh press conference so hawkish that December hike probability jumps from the current 72% toward 85% or higher. That signals phase 1 was a dead cat bounce, not a floor. I'll tell you right now, the setup for a balanced press conference actually exists. The June meeting includes the new dot plot. Warsh is aware that the source of this inflation is an oil supply shock from the Strait closure. Not wage spiral, not demand overheating. Hiking into a geopolitical oil shock risks recession, not just inflation control. Any competent Fed chair knows this. The question is whether Warsh makes that acknowledgement publicly. Watch June 17th closely. Signal 3, Iran. Any credible development before June 25th. This one needs no complicated explanation. Trump said this morning, and this is today, Friday, June 12th, that a deal with Iran could happen as early as this weekend. Iran's semi-official Fars news agency reported that Tehran is likely to accept the agreement. No final text is approved. But the language from both sides has shifted dramatically from where it was 72 hours ago. If the Strait of Hormuz reopens, or if we get even partial confirmation that a framework deal is agreed upon, JP Morgan's own analysis stated that Strait normalization is the single catalyst that unlocks the $80 to $95 range. Because Strait normalization means oil falls toward $85. Oil at $85 means CPI starts dropping toward 3% within 2 months. CPI at 3% means Warsh's rate hike argument evaporates entirely. And that sequence is what unlocks phase 3. All right, let me give you the exact roadmap I'm watching. 6 price zones, 6 catalysts, 1 sequence. 64 to 66, right here, right now. This is phase 1 and early phase 2 territory. We're holding $64 on the QOT report. We're not getting blown out by Warsh's June 17th press conference. And Iran talks are at least stable, if not progressing. The floor is being established. No explosive move. Accumulation by participants who understand the structure. This range requires patience. $67 to $72. Unlocked by Warsh's June 17th press conference, avoiding an explicit hike commitment. OR by any confirmed progress in Iran negotiations. This range reclaims levels that held silver from February through April. At $71.09 specifically, that is the technical decision level that separates the bearish and bullish technical scenarios. A weekly close above $71.09 is phase 2 confirmed. $70 to $80. Unlocked by the combination of a non-hawkish Warsh and early signals from the May PCE on June 25th that monthly core inflation is decelerating. At this level, the gold-silver ratio starts compressing toward 58. When the ratio hits 58, institutional ratio compression strategies begin entering at serious size. This is where JP Morgan's $84 to $85 year-end target becomes visible on the forward curve. $80 to $95. Unlocked by actual confirmed Strait of Hormuz reopening. 1 session. That is how fast this range comes back when that catalyst hits. It happened in May when one leaked memo about Iran talks sent silver from $73 to $82 in 2 sessions. It happened again when the US-China tariff truce added another 6%. The mechanism is the same, cascading short covering from positions built during the drawdown. CoinCodex's year-end model puts silver at $95.69 in December, $95 to $120 and beyond. This is where the structural story fully reasserts itself. The supply deficit doesn't go away when the war ends. The solar demand doesn't disappear. The EV demand doesn't disappear. The AI data center demand doesn't disappear. Bank of America's Michael Widmer maintains a $135 to $309 target built entirely on those structural fundamentals. These weren't war targets. They were structural targets. The war delayed them. It didn't invalidate them. Look, I'm not going to pretend this is a one-way bet. You need to understand the risk scenarios because they're real. FX Leaders published a $58 price target this week. Trading Key is calling for a dip below $60. The death cross formed on the chart. The 50-day moving average crossed below the 200-day. The consensus right now is maximum bearish. Here are the scenarios where that consensus is right. If Warsh's June 17th press conference is explicitly hawkish, if the dot plot shifts toward 2 hikes by year end, and he signals that the Fed sees inflation as structural rather than geopolitical, the floor at $63 breaks. You test $60, maybe $58. If Iran talks collapse this weekend and military activity escalates further into a broader regional conflict rather than de-escalating, you get continued oil pressure, continued rate hike fears, continued dollar strength, and silver grinds lower. If today's QOT report shows commercial hedgers have not been covering at the lows, that the smart money in the physical market is not buying this dip, that removes a key confirmation signal and makes phase 2 less likely. I want you to go into whatever positions you're considering with those risk scenarios clearly defined. The price roadmap I gave you is only valid if the signal sequence unfolds. If it doesn't unfold, if Warsh is hawkish, if Iran escalates, if the COT is wrong, you need to know at what price level you are wrong, and you need to have that level decided before you put on a position. Okay, let me bring this together. Silver opened this year near $100 an ounce. It hit $150 in January. Kevin Warsh's nomination sent it crashing. The Iran war's effect on oil prices added the second layer of selling, and by Thursday morning, it was sitting at $63.52, down 45% from its January high. And then it held. It absorbed everything thrown at it, and it held. This morning, there are credible reports from both the Trump administration and Iranian state media that a deal could come as early as this weekend. The ECB just raised rates specifically because of war-driven energy costs, which tells you the inflation mechanism here is not structural. It's geopolitical. And geopolitical inflation has an off-ramp in a way that wage inflation doesn't. The gold-silver ratio is at 65, near its most extreme reading since the pandemic crash. Silver has now posted 5 consecutive years of structural supply deficit. Bank of America sees $309. JP Morgan sees $84 to $85 by year end once the straight normalizes, and the crowd is still writing about $58 targets and death crosses. That gap between what the crowd is saying and what the structural data is saying is exactly where markets are made. Here's what I want you to do right now. 1. Watch the COT report at 3:30 p.m. Eastern today. It's free. The CFTC publishes it every Friday. Look for commercial short covering at the $63 to $64 level. 2. Watch Kevin Warsh's press conference on June 17th. Not just what he decides, what he says. The dot plot and language matter more than the rate decision itself. 3. Watch the Iran situation daily. When the straight confirmation comes, and I believe it's closer than markets are pricing, the move in silver will not wait for you to catch up. And 4. Watch the gold-silver ratio. The first weekly close, below 62, is the earliest technical confirmation that phase 3 has begun. This is not financial advice. You need to do your own research, understand your own risk tolerance, and consult a professional for your specific situation. But what I can tell you is this. The crowd that is maximum bearish right now, writing about death crosses and $58 targets, is looking at the same charts everyone else is looking at. They're not looking at the QOT structure, the ratio, the supply deficit, or the specific sequence of catalysts in the next 3 weeks. The recovery from the March 23rd panic low to $86 in May happened while most people were still talking about why silver was broken. I think something similar is setting up right now. Subscribe if you want me to walk through every signal in this sequence as it unfolds. I'll do a dedicated video on the QOT report as soon as today's numbers are out. I'll cover Warsh's press conference live next Tuesday. And when the Iran news breaks, whatever direction it breaks, I'll be here with the immediate implications for this market. Drop your thoughts in the comments. Are you watching the same signals? Are you positioned or waiting? And what's your read on the Iran deal timeline?